An economic shock is imminent. I'm your host, Steve Van Metre, and thanks for joining me today. And in our headline story today, the World Bank just released a report saying the global economy is on the brink of a recession and policymakers need to act now. In today's show, we're going to look at the claims the World Bank is making and see if it's too late for policymakers to even stop what is coming this year. Plus, we've got inflation expectations crashing, used cars prices crashing, and as you know it, central bankers in denial. Let's over to Bloomberg, where we picked today's story up with a headline: World Bank cuts 2023 forecast and warns of a global recession. Inflation, interest rates hike, and war remain among the challenges. And this is a case that we're starting to hear more and more. You're starting to hear analysts, banks, policymakers start to suggest that, hey, we're going to see a recession this year. The question isn't, is the global economy slowing down from the pandemic boom? The question remains is this indeed the mild pullback that the Fed wants, or are we on a trajectory for a hard landing? The World Bank slashes growth forecast for most countries and regions and warned that a new adverse shocks could tip the global economy into a recession. Global gross domestic product will probably just increase 1.7% this year, about half the pace forecast in June. That would be the third worst performance in the last 3 decades or so, after the contractions of 2009 and 2020. So you can see that, we look at the data from last week. We saw the ISM, the manufacturing PMI, the services PMI, and what are we seeing in the economy? That everything is rapidly slowing down. We noted that new order growth, a key driver of economic activity, is slumping. And eventually, if things don't turn around in the months to come, we're going to see employment crash. And now the World Bank is reassessing its view from not too long ago, saying, hey, you know what? The economy is slowing down, and at this current rate, it looks like we're headed to recession, because this is the same type of data we've seen going into the last 2 recessions. The bank would also cut its growth forecast estimates for 2024, because you might as well at this point, said persistent inflation and higher interest rates are among the key reasons. It also cited the impact of Russia's invasion of Ukraine and a decline in investment. So the question now that we should be asking, we need to figure out, is if the World Bank's claims as inflation and interest rates a problem, the answer is, are they? Well, let's go to the charts now and see, because as you're about to find out, well, they're right. Here we can see gross domestic product, that in blue, on a year-over-year rate of change against the consumer price index, as always, on a year-over-year rate of change. And what we can note is you can see periods of high inflation or rising, we'll say rapidly rising inflation, lead to a slowdown in economic activity. Now, the economy can initially absorb the move, but if it continues to persist, well, they're right. The high inflation is indeed a problem. Now, they noted persistent inflation, but what you can actually see here is the economy can actually handle fairly persistent inflation. Even if it's going sideways, the economy can handle that growth. It's that rapid and almost last rise that happens into a recession before, of course, economic activity starts to turn lower. So in the case that they're making the claim is, yes, inflation is indeed a problem. And as we know from the show, we talk about the reason is wages never keep up with it as much as we need them to and want them to. And of course, the Fed says, hey, I want to slow wage growth down so you can't afford things. And if you can't afford them, well, then all of a sudden inflation comes down. So that's why we tend to see economic activity fall when inflation comes down, because of course that leads to layoffs, because as demand goes down, you get the big picture here, economic activity falls, layoffs increase, and next thing you know, you're back in a recession. Now, what about interest rates? Well, they've got that one right too. So here you can see GDP overlaid with the market yield of 30-year Treasury securities. And what we can note again is periods of high interest rates lead to a decline in economic activity. Now you might kind of wonder why, because we can go back and see all these times where falling interest rates are supportive of economic activity, but there are certain points when they get higher that economic activity indeed slows down. Now the question is, why does this happen? Well, it's simple. We're in a debt-based economy. And so in order for economic activity to grow, you need to have the debt or size of the debt continue to expand. And based on at least history of what we know and what we've worked with for decades, that the way you get debt to expand in a debt-based economy is the persistent decline in interest rates. Now, it doesn't have to be rapid. It can be a slow, gradual decline, but that's the problem we see in the data is every time there's a move higher in rates, particularly a sharp move higher, well, that leads to a contraction in economic activity. So the World Bank's got it right. We've got two problems headed into 2023 as we go start the year. We've got high inflation, which we now know is starting to cool off, and we've got high interest rates, which are also starting to come down, but the damage being done by the two is too late. The crisis facing development is intensifying, and the setbacks to global prosperity will likely persist. In the report, he said GDP in emerging market and developing economies at the end of next year will be about 6% below the expected level on the eve of the COVID-19 pandemic. So we can see the slowdown is broad-based. It's in developed countries, it's in emerging countries, it's a global phenomenon. Of course, we know this was triggered by massive amounts of fiscal and monetary stimulus, and we've eventually had to face the music where there's a slowdown. The question of the difference between whether we have a recession or we have a financial crisis is if the debt bubble bursts. Somewhere in the economy, global economy, do we see the inability to service debt, and do we see that start to create a knock-on effect where that default leads to other debt defaulting and then more debt defaulting, and that's where you get the crisis. If this is just a slowdown before consumption returns, then we'll just have a regular recession. The combination of slow growth, tightening financial conditions, and heavy indebtedness is likely to weaken investment and trigger corporate defaults. Urgent global action is needed to mitigate the risk of global recession and debt distress. And it's always about the debt distress. That's what it always happens to be. And again, we come back to those words I said earlier, a debt-based economy. Well, if you have a debt-based economy and you have debt in stress, well, that leads to delinquencies and defaults, and then there goes your whole financial system depending on how big the debt defaults are. So again, the World Bank is just telling us what we already know is we need the economy to expand to keep the debt bubble from bursting. And the problem is policymakers are doing just the opposite, but for some reason, while the policymakers are going the other direction saying tight, 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 the market keeps going higher. Many people are asking, and now we've got the guidebooks are done. They're under the video guidebook section. Remember, there's a 30-day free trial, so you can jump into CTA-Timer Pro. We're just waiting for feedback from the subscribers, but you can see the fast algorithms are buying futures here on the S&P. They're increasing their position. That's what we see. So if you want to keep track of what's going on with machines, once they get the feedback from our subscriber base, if the reports or the guidebooks are what they want, price is going to $30 a month for new subscribers. You can lock it in now. But one thing that is falling is inflation expectations. U.S. consumer inflation expectations slip in the New York Fed survey as median one-year ahead inflation expectations declined by 0.2 percentage points to 5% in December, the lowest reading since July of 2021. And expectations for inflation's three-year ahead were unchanged at 3%. So keep in mind now, what this means is you're likely to see interest rates continue to go down because we see, of course, interest rates on the longer end of the curve are a function of growth and inflation expectations. Now you're seeing inflation expectations come down. When growth comes down, well, then you're going to see a rapid drop in rates. But what is, again, the driver for inflation expectations? Well, we already know it's gas prices. And here you can see in this chart the University of Michigan inflation expectations in blue, with the U.S. regular all formations gas prices in red. So we can see inflation expectations from the consumer perspective should continue to fall, and that should backfeed into surveys when we see in the months to come. And since gas prices are running roughly a 0% year-over-year rate of change, it means inflation is coming down. And more evidence of that is in the used car market. Used car prices record the largest annualized decline in series history as Cox Automotive reported this Manheim Used Vehicle Value Index, which tracks the auction price of used cars, plunged, get this, the most on record in December from a year ago as the auto market cools. This was the largest annualized decline in the series history. And here you can see in that chart where the dot-com bubble, you see kind of burst and used car prices fall. Then they chart the great financial crisis, then the COVID pandemic, and now they're saying this is due to Fed tightening. The question is, what does this mean for inflation? Because that's really the story here, is when is the Fed going to pause and maybe reverse to alleviate what the World Bank is saying is, look, we're on the edge of a recession here. We've got a lot of problems. When are policymakers going to react? And of course, you and I know, and we talk about on the show, the reaction is always way too late. But I want you to see just how used car prices work in the big picture of the CPI and are leading us down. Here in this chart, we have the consumer price index in blue and the sub-index of the consumer price index for used cars and trucks in red. And you notice it is more volatile, and that is to be expected. But you'll notice that periods of declining inflation you see in blue are often led by a decline in used car prices. We see that now they're running a negative year-over-year comp on that, and that means headline inflation at some point is likely to follow. But don't ask the Fed when it's going to stop, because Fed's Bostic favors holding rates above 5% for a long time. And of course, we note that he is going to be so wrong about that statement, unless a long time means a matter of, well, perhaps months. We are just going to have to hold our resolve, he told the Atlanta Rotary Club on Monday, as Bostic remains committed to tackling high inflation and warrants interest rates into the 5 to 5.25% range to squeeze demand out of the economy. Asked by the moderator how long he saw rates above 5, he said 3 words, a long time. But I've got some words for Bostic. It's called the bond market, and the bond market's saying, pal, you're not going to hold rates this high, hardly any longer. Here we can see the federal funds effective rate in blue against the 10-year constant maturity minus 3 months constant maturity yield curve in red. We note that inversions, which is when the red line is below the horizontal black line, indicate the Fed is at a point where if it's not pausing, it soon will be. And well, we're well below the black line, of course, the longest in history based on the data series available here, suggesting that even though we may see Powell hike again in February, and who knows what his excuse will be if he actually goes through with it, what we can say is Fed hikes are over at this point, and the next direction only will be down, and the question remaining when they're going to cut. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.